Good afternoon, everyone. In today's video, I'm going to focus in on the 9:30 a.m. Pacific mark, and we'll look at that time period in all four of our major index markets. We'll start with the S&P and really then cycle on to the Dow, the Nasdaq, and the Russell. And along the way, I think what you'll find, at least to be interesting, is how the volatility leading up to this 9:30 period really translated in what we saw in terms of buying activity when we had buyers buying the dip. All right, so let's get started first with the S&P 500 futures, and then we'll make our way down. If you'd like to skip to a specific market, you can also use the timestamps in the description box below. This video will focus less on the mechanics, but if you are interested to learn more around how to actually trade this setup, I'll leave a link to that as well in the description box. Now, before we dive into charts, headed into 9:30 on the S&P, we were on our aggressive volatility box models. On the Dow, we were on the aggressive model. On the Nasdaq, however, we were on our Doomsday Aggressive models. That means the Nasdaq was more volatile than the S&P and the Dow headed into the 9:30 zone, which caused us to already be a bit more cautious on the Nasdaq compared to the other two markets. And then finally, the Russell here had broken outside of its Doomsday Aggressive models most recently, and that then took us to the conservative headed into the 9:30 zone. So in terms of where we were most cautious, that was the Russell futures market, then the Nasdaq in terms of second most cautious, and then finally the S&P and the Dow we were the most aggressive on, looking to try and buy dips. Now let's take a look to see what actually ended up happening. So coming into the S&P 500 futures here, in that 8:30 zone, we ended up breaching our volatility zone, but we did not see our confirmation signal prior to going outside of the clouds, and that then took us from the aggressive to our Doomsday Aggressive. So 9:30 really strikes. Price action at that point is outside of our clouds. We need to adjust, find a better volatility model. That's where we had the Doomsday Aggressive model come in. And there, price action was doing a much better job of holding our Doomsday Aggressive model. You'll notice here price does not go outside of the clouds. That's what we're looking to see. And while price action is still contained inside of this zone, we have the edge signal confirmation. Now for our volatility box entry, we're looking for an entry at the sign entry line. We did not get that filled. The only entry that was filled was for more aggressive traders, either using the close of the edge signal confirmation or the actual zone between the gray dash line and the sign entry line. But either way, a little bit more aggressive of an entry where you don't mind giving up a few points in the idea of trying to catch a bigger, longer reversal. And that's exactly what this move was today in the S&P 500. From really that edge signal confirmation all the way up to the max potential point that we had for today was a move of right around 0.79%, which is a consistent theme, but the Russell there had the greatest move in terms of low to high, which we'll talk about in just a few minutes. So here's the recap for the S&P. The only entry that you had was the more aggressive entry inside of the zone. Sign entry line didn't get the fill. However, this move did lead to a nice T1 and T2, hitting both our first and second targets, and then some more in the S&P for anyone who was looking to try and play longer term home run sort of plays. Now, next up, let's take a look at the Dow futures market. So the Dow, very similar to the S&P, we started off with the aggressive. However, inside of the Dow, we stayed contained inside of the aggressive and did not really break outside of the clouds in that same 9:30 zone. So already you have this idea that the S&P now is more volatile between the S&P and the Dow. So we've broken down that rank a little bit further. Now inside of the Dow here, very similar setup. We're looking for a breach of that sign entry line. We then had the edge signal prior to us going outside of the clouds. And that then really opens up this trade. Our risk is between the sign entry line, where you did get a fill in the Dow, to the outer edge of the clouds, and we're looking for that same move on the opposite side. That was right around 45 points in the Dow today during this trade. And then the second trade, or second target, excuse me, is at the gray target line on the opposite side, and that's 71 points, at which point our risk is now 0. We've moved our stop up to break even. In the case of the Dow, we hit both T1 and T2, but the real thing to call out is the much greater move that we actually saw in the Dow, to the point where we hit the other side's sign entry lines, broke outside of it prior to seeing our oversold confirmation. That then took us from the aggressive to our Doomsday Aggressive models. And you'll notice on the other side here, we had a really nice move in terms of buying activity that ended up coming through as well, really making that sign entry line look like a picture perfect entry when you look back, especially knowing that this was off of our aggressive models. Again, 0.77% on the S&P, we saw right around a 0.79%, so more or less the same in terms of the bounce that we saw from the actual entry zones. Now, next up, we have the Nasdaq futures market. The Nasdaq, we were on the Doomsday Aggressive already headed in, so we need to be a bit more cautious. 9:30 a.m. rolls around, you'll see the deeper sell-off where in the Nasdaq, we come all the way down to our Doomsday Aggressive sign entry lines. And that real aggressiveness in terms of being a bit more cautious on our models really came from the strength that we saw. So if you were looking for a market in which you had a pullback in an otherwise uptrend, the Nasdaq was it today. In terms of strength, you compare the Nasdaq's chart to something like, say, the Dow, you can see the very clear difference between the two charts. One's angled up, one's angled down. Now in the Nasdaq, we did not get that same opportunity to enter. We had the edge signal confirmation. The close, if you did use that, did still lead to a fairly nice move in the Nasdaq, greater than even what you saw in the S&P and the Dow, I believe, at right around 0.81%. But we did not get the entry that we were looking for near our sign entry line, along with the gray target line. So it's just one of those trades that we have to sit back and watch the buyers come in on, at least using the trade plan. Finally, we had the Russell futures market, and the Russell here was the interesting market headed in. Let me actually skip to the chart of the Russell. We were on the conservative volatility box models. There we had a breach of our sign entry line. We had the edge signal. You had an opportunity really for a brief moment to enter inside of the zone. And from that point, the Russell really just took off. And if we measure this just from a pure percentage from that close of the edge signal all the way up to our max potential move, you'll see the Russell here 1.36%, much greater than the S&P, the Nasdaq, and the Dow, and really was the market in which you had buyers coming through in terms of full force action. And if you were looking at being a bit more aggressive, the Russell was the market in terms of choosing the best one for today, which would have given you the most gains. Now, if we zoom out here and the one takeaway that we call out, the two markets in which we had the greatest reversals were really the Nasdaq and the Russell futures markets. In both of those markets, we had a breach of more conservative volatility boxes when we compare them to their peers. In the Russell, the conservative volatility models were the ones that we were using at play, compared to using something like the aggressive to try and catch reversals. Using the more conservative models here in both of these cases led to the greater moves and being a bit more aggressive there. If you were looking to try and buy ETF options, something of that sort, that's where I think these markets served you a little bit better today. Either way, I hope this video was helpful in providing a snapshot of what happened today during that 9:30 a.m. sell-off and how that looked like in terms of catching price activity with respective volatility models in the four major index markets. All right, take care, everyone. Good luck trading, and we'll see you in the next update.